Now there's a report by VanEck. Now this is very different than James Rickards saying 24,000 or Mike Maloney saying 10,000 as a gold repricing. Central bank liabilities are divided into M2, divided by gold reserves, $184,000. They say using global M2, we calculate the global price of gold that equalizes M2 is around 100,000 per ounce. Weighted by daily FX turnover for our sample, the gold price that equals M2 is 184,211 per ounce. What I am saying to you is that I have believed this for a very long time, that gold will be reintegrated as the de facto reserve status.
VanEck has released a bombshell report that dwarfs previous bullish forecasts, projecting a potential gold price of $184,211 per ounce. Unlike the $10,000 or $24,000 targets set by industry pundits, this model divides the central bank's M2 money supply by gold reserves to arrive at a stunning valuation for a global reset. Andy Schectman, president of Miles Franklin, emphasizes that this analysis confirms his long-standing prediction of gold's reintegration as the global reserve standard. He notes that while VanEck's data shows a global M2 equalization price of $100,000, the figure jumps to over $184,000 when specific central bank liabilities are weighted by daily forex turnover. Schectman argues this is not merely a theoretical exercise, but a glimpse into the necessary repricing required to restore credibility to a debt-saturated fiat system. This report marks a significant departure from standard market commentary, suggesting that gold is being quietly positioned as the de facto reserve vehicle of the future. As the world drowns in unbacked liabilities, the mathematical necessity of revaluing gold to cover the M2 supply becomes undeniable, validating the strategy of holding physical metal before this inevitable reset occurs. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
This is very different than James Rickards saying 24,000 or Mike Maloney saying 10,000 as a gold repricing. But here's what they say. They say, what do they say? Sorry, I have it right here. Okay. What if gold replaces the US dollar as the reserve standard? And I would argue that is what is happening in more so the Treasury, each country using their own CBDC, trading with one another over rails that are not SWIFT compliant or accessible, and using gold as the reserve status, as the reserve vehicle instead of treasuries. They say in this paper, our emerging markets bond team values gold by matching central bank money liabilities to gold reserves, implying a 39,000 to 184,000 per ounce price. They talk about M0, which is the base level of money. And if they use M0, just to skip to the good stuff, liabilities divided by gold reserves at M0 is $39,000 per ounce, weighted by daily FX turnover. If central bank liabilities are divided into M2, divided by gold reserves, $184,000. They say using global M2, we calculate the global price of gold that equalizes M2 is around 100,000 per ounce. Weighted by daily FX turnover for our sample, the gold price that equals M2 is 184,211 per ounce. What I am saying to you is that I have believed this for a very long time, that gold will be reintegrated as the de facto reserve status, the reserve vehicle, the preferred reserve vehicle of the world. And it's happening in the global south now. And if Judy Shelton is right, and she came on your show and mine and said that she believes, and Trump told her that he will peg the back end of the bond market to gold with the Genius Act working on the front end, if indeed that were the case, right? If you have to sell a $20 million bond in 30 years, deliver $20 million in gold in 30 years at 5,000 an ounce versus 184,000 an ounce by the time you get there, you sell it at 5,000 an ounce, and you're delivering it when it's $184,000 per ounce, you've just massively, exponentially cut the number of ounces you have to give. What else have you done? You've massively devalued the dollar. We're moving away from the dollar being the de facto global reserve currency, I believe. And I think that she is basically saying that once we cut the reserve status to gold, once we cut the tether, the line to gold in 71, that the dollar has been losing value ever since. And it is a system that has lost trust, and our fiscal irresponsibility is such that who in the hell would want to take our dollars anyway? It's ironic she mentions gold. I think that you will see more and more talk of gold replacing the U.S. Treasury as a de facto reserve settlement vehicle. And whether it be in treasuries here or to settle currency and trade imbalances in the new multi-jurisdictional Shanghai Metals Exchange platform connected to the digital yuan, which will be the rails to the mBridge unit tokenized currency, which is actually now working and running and has passed beta tests. So these things are happening, whether the West wants to agree with it or not. I think she's probably being a little bit more honest, kind of veiled honesty, but more honest than I think you'll hear from a politician on this side of the pond. The only way to get credibility and to have people buy our bonds, because if not, we're dead, right? Who's going to pay for all of this? Or we're going to monetize it and create hyperinflation within our own borders, is to have the gold backing. You look at the Genius Act, which basically says that the interest that is created on the treasuries that back the stablecoins, and this goes into effect January, like right around January 1st of next year at the latest, is not transferable. So what has Tether been doing with the interest that they're accumulating on these stablecoins and the treasuries that are up to 90-day treasuries that are one-to-one linked to the stablecoin? They're buying gold with it. They have 14 billion in gold already, the single largest stockpile in the world next to central banks. What does that do? That devalues the dollar. And that's what they want to do, to sell products to the world. And if they peg it to the back end of the bond market and use anytime money moves after this is implemented, anytime, it creates synthetic demand for the front end of the curve. Up to 90 days will back the movement of money. The stable coin rides on the rails of the blockchain and is backed one-to-one with short-term 90-day or less treasuries, which the interest is not transferable to the holder of the stablecoin. When I send you money, a stablecoin is created. It's backed by a treasury. When you get it, stablecoin is burned. That treasury interest, that stays with the issuer. So that issuer then has to do something with it. They've been buying gold, which is my theory, which is why you will see gold go higher, the dollar go lower, in an effort to bring back manufacturing and sell it to the world. But how do you bring it back? Well, you create zero coupon bonds back to gold. And as the price goes higher and higher and higher over the duration of the bond, and when you finally have to deliver the gold at maturity, gold is way higher than when you sold it, and it's just a fraction of the ounces. This gives you a chance maybe to grow yourself out of this problem down the road. Otherwise, what do? You inflate or you default like every other government has done before us. I think what President Trump is doing is to have the courage to make the realization that the can has been kicked far enough and we can't keep doing it, or our kids and our grandkids have no future. And that's just the truth.
VanEck has released a groundbreaking report that models a scenario in which gold replaces the US dollar as the global reserve standard. Their analysis suggests that if central banks were to back their money liabilities, M2, with gold, the implied price would skyrocket to $184,211 per ounce. This projection aligns with a broader geopolitical shift where nations are increasingly settling trade using gold-backed CBDCs on non-SWIFT rails, effectively bypassing the U.S. Treasury market to restore monetary credibility. Market experts argue that this revaluation is already being quietly implemented through mechanisms such as the Genius Act and actions by stablecoin issuers. Entities like Tether are reportedly using interest from Treasury holdings to accumulate a massive $14 billion gold stockpile, effectively devaluing the dollar to synthetic levels. This strategy allows the U.S. to potentially soft default on its debt by repaying bonds with significantly revalued metal while simultaneously weakening the currency to resuscitate domestic manufacturing. Let's get back to the interview.
He who has the gold makes the rules, and I think he is preparing for that. And I think there is nobility in what he is doing. I do. Honestly, I do. Everything he's talking about has gold in it, even the Golden Dome. It was called the Iron Dome, I thought. Now it's the Golden Dome. He keeps making these comments about it. And I think there is a realization that gold is going to be rewired or reworked into the system. I think he understands that. I honestly believe that he got together with the Now, again, I could be naive. Maybe I'm wrong, but it just seems too coincidental that, when he comes into office, before he even takes office, when he wins the election, all this gold starts coming back. And I think they got together with the banks and said, you idiots are so far short, it is an existential threat, and the rest of the world is buying it. So here's what we're going to do. We're going to tell everyone this is about tariffs, and your collusion that you've been doing for the last 30 years, you and the European banks and the banks in Canada, to maintain dollar supremacy, bond market supremacy, and to keep silver cheap for the military. Well, we're going to say that has to, you got to just send the bars back. Don't worry, it's a one-way tariff. This will end. You got to send it back. We got to cover, and we're going to reshore it. And it is not going to go back. And they've been bringing all this gold and silver back to the tune of billions and billions and billions and billions and billions of dollars worth every month, because he sees what's happening. And they understand that the global south is already ahead of us in reintegrating gold into the system, and we have to do it as well. And I think the same thing is true about silver, and that is why you saw all of these imports.
Right.
And ironically, they classify it critical. Go and try, and talk to 10 of your oldest friends about gold and silver for 30 seconds. And yeah, they may say, yeah, I see it's been going up, but that's it. You see nothing, you hear nothing. When Reuters talks about silver's run, just like TD Bank, they call it the devil's metal. And I mean, everything is in a negative light. It's overbought, it's peaked. It's just like 2011. It's just like 1980. I mean, and I think it's just completely been ignored. Now, as he points out, the S&P, not only did it underperform European, it wickedly underperformed gold and silver. And this in the face of a 19% gain or so, 16, 17, 18, 19% gain in the S&P, in the face of the greatest tech boom ever with AI, NVIDIA and whatnot. And gold is up 70% and silver 150%, and not a flippin' word by the mainstream. And even more importantly, if they would have followed that trail, they would have led them to the COMEX. Who the hell's doing this? Who's doing it every month? Who's standing for delivery? Who's spending billions and billions and billions of dollars? Where is the journalistic integrity? Ray Dalio, I give him credit. He's a mainstream guy who has the courage to say what he feels, even though he may not really be saying it like he wants to, but he gets it. And he's been talking about gold for a long time. Well, and the fact that no one's talking about it, but a guy like me trying to figure it out, I mean, that's the point. It doesn't matter who's buying it. The fact that someone is, or someone's are, is all that matters. And when you see at that level, I would argue, when you're spending hundreds of billions of dollars, and it never really has happened before ever to this degree. I mean, sure, we've been net exporters of gold for most of my career, 36 years. Now we're maybe the largest importer. And you just see massive imports coming in. The question should be asked, who's doing this? Why all of a sudden? It's really very unusual. And that to me is the most important part, because at that level of money and wealth, they know the playbook. Their information is worth more than the money they use to buy the stuff with, which is worth more. The stuff they buy is worth more than the money used to buy it. So, information is at the top, and what they're buying using the money that they're using to buy it, or the currency, I would argue is very smart. And to Ray's point about, or to your point also about, all these companies or countries or pension funds or whatever moving away from dollar. Why would anyone want to hold a dollar? The measuring stick by which we measure the dollar, the Dixie, the dollar index, is flawed, because all of these countries are constantly devaluing their currency against ours. That's just the way it works. And whether it be to sell exports, or because you have to go into the open market at some point to buy more dollars to transact global business, unless you hold a huge stock of them or stash of them, reserve of them, that means you're holding our treasuries too. Both are a sucker's game. So you look at a dollar index that says the dollar was down 9% this year. Okay, how about against silver? 150, gold 70 or 80. Point of it is that why would anyone want to hold our dollars? They have the lasting power of a melting ice cube. And why would anyone want to hold our treasuries? Not only have they performed horribly, half the performance of the 10-year treasury for 25 years. Look at the last 2 years. Gold up 40% in 2024. 2024, the 10-year treasury up 4.5%, 5%. Okay. How about last year? 10-year treasury up 4%, gold up 70 or 80%. Keep on going. But it has no counterparty risk. So these things are very, very obvious if you look close enough, and Ray's saying it. And that's what the pensions are saying. No, it's not about Trump. I believe it's not about his policy. It's about the fact that we have ridiculous fiscal irresponsibility and that we are selling and so much debt. We're going into $1 trillion of debt still at the clip of 100 days per trillion. And, that's not sustainable at some point. Now, people point to Japan and say, well, they're 300% debt to GDP. Yeah, but they have the largest savings in the world. They have a net surplus in trade. Everyone buys from them. And the Bank of Japan owns most of it, but they're not the reserve currency. We are. And that's going to have a problem. Now, you pull all this money out from the yen carry trade, the reverse yen carry trade will be just as disastrous as it was bullish. Now, it hasn't crippled it yet, but the Japanese bond market is breaking and rates are going higher, which that means you will see more capital, including that, rumor has it, of Warren Buffett, who has been sitting on the sidelines with $400 billion in cash, is now deploying money in Japan, so I hear, because he sees opportunity there. So I guess my point is that recency bias, normalcy bias, all of these things that the mainstream points to and the media neglects, to me, are very clear and easy. Who's doing it? That's unusual to the nth degree, and that's all you need to know, because at that level, information is key, and they know it. They know where it's going, and it's followed the central bank path for the last 5 years. You can see it. Central banks led the way because they write the book. The folks here in the U.S., well, they're part of that book.
The geopolitical landscape is shifting under the maxim, "He who has the gold makes the rules," prompting the United States to reverse decades of monetary policy quietly. Data reveal a stunning pivot. The U.S. has transitioned from a net exporter to the world's largest importer of precious metals, repatriating billions in bullion to counter the Global South's advances. This massive reshoring effort suggests a coordinated realization among power brokers that the dollar's dominance is fading and gold must be reintegrated into the system before it is too late. Strategic analysis emphasizes that this silent accumulation by smart money is the ultimate signal for investors to act. There is a glaring disconnect where mainstream media ignores gold's 70% and silver's 150% gains, obsessing instead on an S&P 500 that is significantly underperforming tangible assets. Experts warn that holding treasuries has become a sucker's game, with the lasting power of a melting ice cube, urging individuals to follow the insiders who are trading dying currency for hard assets before the public wakes up. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.